I raised, I had a target, I think, of 125 on silver and 5,500 on gold
Yeah.
going into this year. But I guess that was my numbers in my January letter, early in January. And then we had that big run from December through the end of January where silver went to 122. I had 125 target. And I looked, it was a parabolic run. It went from 50 to 122 in a big hurry. And gold had a nice run too. And I re-looked at it. I said, this is parabolic. Is this the end? And there was nothing I saw in any of my work that said this is it. So I raised my target from 125 on silver to 180. And I think I went to 6,800 on gold. I've since raised my target again back in early June. So the gold now is 7,000 and silver is 200. Not huge increases, but I felt there was room for more. Obviously, there's one guy out there in particular who's been calling much higher numbers on silver. And I said, I can't rule it out, but I can't get there on my work. So I'm not
Yeah.
going higher than 200. But, really, I raised in early June. So since then, we've gone the other way. And my calls aren't based on short term anyway, so that didn't bother me. But I thought, okay, we're going down, and maybe we'll hold 70, and that didn't hold 70, so maybe we're going back to the retest the lows. And today scares people because it broke that. But I'm sticking to my guns that I think we're very close to a big reversal here. And I think we will see those numbers. I'm not changing or feel any kind of desire in any way to change those numbers and lower my numbers or reverse myself.
According to David Hunter, gold and silver's brutal sell-off is likely a capitulation low, not a breakdown, with silver targeting $200 and gold $7,000 near term. He sees S&P 10,000 before year-end, then an 80% crash, $200 gold, $1,000 silver, and a commodity supercycle unlike anything in modern history.
The metals have gone further in this correction than I expected. I mean, up until today, it looked like a classic retest of the lows, the March lows, and then the lows of a couple weeks ago. And obviously, silver and gold both broke through those lows today. That always brings out the fear, and all the technicians who follow momentum and start, and there were some, to their credit, that were looking for silver to get into the 50s, and actually 50 or 54 were numbers I saw. I don't think we're going there, but to their credit, they certainly had lower numbers than I did. But I've seen this too many times where you get these breaks, everybody gets bearish and nervous and scared. And it's just a minor break of a retest. So we saw it in the S&P back in October of 2022. The S&P broke below the lows that had corrected to then, and went to I think 3490, and people got came out of the woodwork calling for 3,000 and maybe 2,000, and that was the turning point. And you see that a lot where there's a minor break just to kind of get the capitulation in, to get all those people bailing out. We'll see. It's still too early to say for sure. But the silver did come down to a trend line today and bounced. It's not a big bounce yet, but I think there's a pretty good chance. When you look at RSIs and stochastics and everything's oversold. There's a pretty good chance that this was that capitulation sell-off, capitulation low that gets people looking the wrong way, and then it reverses. So I don't want people thinking it has to happen today or even the next couple of days. So I am not looking for new highs in the stock market. I think because we're going to go down 80% coming out of that 80% hole. It means you have to go up many-fold to get back to the highs. I think we will go up many-fold. So you could, as I say, if you use 10,000 on the S&P and you go down 80%, that's 2,000. You could quadruple and only get back to 8,000, which is short of that 10,000. So you could have a great cyclical bull market, but still be in a secular bear market as we go to lower highs and lower lows in the next cycle. and that'll play out over more than a decade. But yes, people should understand that even though we won't see these highs again, I don't think, maybe in our lifetimes, but certainly I think it'll last for a long time, these highs this year. That doesn't mean there's no opportunities the other side of the bust. You can have some very big cyclical moves. And again, the next cycle is going to be all about commodities, a continuation of reshoring, a continuation of reindustrialization. That's going to benefit the commodities more than anything, because you're going to need steel, you're going to need copper, you're going to need tin, you're going to need zinc, you're going to need everything to build out. And of course, AI needs a lot of those things too. So the next cycle is going to be commodities will lead, there'll be aspects of tech that'll probably still play, but tech's a growth industry where lower rates matter. Growth stocks benefit from rates going down or at least holding steady. In an environment where rates could go from 0 to 20%, over a course of 7 or 8 years, that's really punishes growth stocks, and it punishes PE multiples, or shrinks PE multiples. So then the benefit is really to be in those industries where their earnings can outstrip inflation and outstrip the interest rate rises. Those industries are commodities and probably industrials more than any others, materials. It's going to be a very different, every cycle, every big cycle has different leadership. This one's been tech for sure. The next one's going to be commodities. And to throw in the one thing that will see much higher highs, I think, are the metals. Precious metals in particular. I think you could see 20,000 on gold, and I've raised my long-term expectation on silver to maybe 1,000. So still big moves in those, even though they'll correct during the bust. They will come out the other side with much higher highs. The one point I want to bring out in all of this is that if you have what I'm calling for, which is a bust and bear, and the bear being the biggest we've had in post-depression era, and not getting back to the highs next cycle, it's important for people to realize that whole mantra that's worked so well for the last 4 decades of it's time in the market, not timing the market. It's buy and hold, because you're always seeing the market go to higher highs and stocks go to higher highs. In the next cycle, that's not going to be true, which means if you hold through the bust, you may not get back to where you are today or back to where you are at the top this year. And so it's a very different mindset. It just means rules can hold for a long time, but not always hold. And I think in this case, timing the market will be important, not precise timing, but just understanding that enough is enough. Once you've made a lot of money, don't get greedy. Understand that you can give up a lot in a bear market, and then coming out the other side, you may not get it back, not get all of it back.
Are you still thinking that the NASDAQ and S&P could hit those ultimate highs before the end of this calendar year?
For sure.
Okay.
In fact, that's I think the probabilities are high that it happens this year. Whether it happens, I've put myself out there and say things like it could happen by Labor Day or it could happen by fall. Whether it does or not, we'll see. But the point is, if we're in a parabolic and if it starts really getting going, coming out of this most recent short sell-off, it's going to get steeper and steeper, and it's that steepness that can happen very fast. So this year, I think for sure, and before the election, I think it's pretty likely.
Yeah. Are there a couple things that you would tell investors to just, hey, be aware of?
Yeah, probably the most important thing to know is that the other side of the mountain can be fast and furious. So, it's going to behoove you to be early, not late. That doesn't mean you can't, if you miss the top, you're done, because it could take a first step down of 20 or 30% and then bounce. But it's going to be very hard to know exactly what pattern it is afterwards. And this week's a good sign, even though it's been a 4% correction in the stock market. But even that 4% happen fast, and certainly in the AI stocks, it's a lot more than 4%. So,
Yeah.
but it's going to behoove you to be early probably and not get greedy. I've been pretty vocal about saying, don't, because this is the other risk, is that people say, well, I'm not smart enough to pick a top, I'm getting out now. And I go, the problem is, because I think there is this last parabolic run, you run the risk if you get out too early, and it's not too early in time, but too early in the market. You run the risk of getting out and then feeling like, hey, everybody's telling me this thing's got years to run, I got to get back in. So you got to play that carefully and understand. That's why I keep saying I'm not at all. It's conviction, but I'm not at all close to saying a top yet. Even though the top is likely this year.
Yeah.
There's potentially 30% plus upside from here before we top, and so you got to just kind of play that. Now, does that mean I'm right? No. Does that mean that you should stay right to try to get that last 30? No.
That
But
last
somewhere between here and 30% higher, I think is where you might want to just start scaling out, not all in and all out, but just say, okay, I'm going to take a little off the table just to get used to going the other way,
Yeah, and I mean, and you've also moved your targets up over the years, right?
Yes. That's the other risk is I feel we are getting close in time, but I've called, I've said we could top this year for several years. I never got close. I'm very much the same as I am now. I never got close to saying we're at that level. Yeah, the top is in, and I was wrong. I kept moving my target higher because I never saw that, because more than anything, because sentiment remained very subdued. That's probably the biggest focus. If I were an investor, I'd say, and I've said this many times, but when you hear everybody saying this thing has years to go, that should be your first signal that it's time to begin scaling out, because that's the top is going to be when everybody's all in and they think there's a long road ahead. And I keep telling people it's not going to be easy at the top, because there's going to be a fundamental story, and what will fuel it on the upside. I think we are going to have. Oh, and the other thing is obviously a stronger dollar, and people are seeing that break out from a few month consolidation and thinking we're off to the races. I think the dollar will reverse also. So you'll have a weaker dollar, in my opinion. It's not there now. And lower interest rates. I think the bond market looks really good here. And so in spite of all the worries about what Warsh is talking about, or basically, I think what scared people is when he said, we're going to take care of inflation. That's our one and only mandate, that we are most focused on. And don't worry, we'll get to that 2%. I think that worried people. I'm not worried about it, because I don't think inflation is really a problem here. I think it's peaking. Obviously, oil falling from where it was down to 70, actually got below 70 this morning. I was one of the very few all the way through this that said once we get some agreement, you're going to see oil back into the 60s. And I didn't know it would happen quite this fast, but I think it's going to continue in that direction. There'll be bounces, but that will help the bond market for sure.